Welcome. Today we're uncovering the crucial difference between your credit card statement closing date and your payment due date. Understanding this cycle can help you stop paying unnecessary interest and make the most of your card's grace period. Let's get started. First, we will explain why this topic matters. Next, we will define the closing date and due date. Then, we will visualize the cycle with simple diagrams and walk through a step-by-step system to stay interest-free. After that, we will bust common myths, test your knowledge with quick quizzes, and wrap up with pro tips, a brief disclaimer, and a concise summary. To begin, here is why this matters. Confusing the closing date with the due date causes people to carry balances unintentionally and pay avoidable interest. By mastering the difference, you can maintain a zero-interest status while still using your card for everyday spending. Additionally, you will protect your grace period and extend the time you keep cash in your account. Now let's define the essentials. The statement closing date is when your issuer tallies all posted transactions into a statement. Purchases that post before this date appear on the statement. Those posting after belong to the next cycle. Next, the payment due date is usually 21 to 25 days after the closing date. To avoid interest, pay the full statement balance from the prior cycle by the due date. Meanwhile, the grace period gives you interest-free time between when purchases post and the due date, but only if you paid the last statement in full. The golden rule is straightforward. You do not need to pay your current balance to zero. You only need to pay the statement balance by the due date every month. Moving on, let's visualize how charges flow. A purchase is made and then posts. If it posts before the closing date, it is included in the statement balance for that cycle. If it posts after the closing date, it moves to the next billing cycle and appears on the next statement. When the payment due date arrives, if you pay the full statement balance, your grace period is preserved. If you do not, interest will be charged on applicable balances. Importantly, transactions made after the closing date are not due until the following month, which means you do not need to rush to pay them immediately if you already paid the prior statement in full. Next, let's compare the two dates directly. The closing date generates the statement, marks the end of the cycle, and determines what is included in the statement balance, and also starts the clock for the grace period, typically 21 to 25 days. The due date is the final deadline to pay that statement balance. Paying it in full preserves your grace period. Missing it can lead to interest and possibly late fees. Thinking of the closing date as the meter reading and the due date as the payment deadline is a helpful mental model. To make this concrete, consider an example. Suppose your closing date is January 10th and your due date is January 31st. A purchase that posts January 5th lands on the January statement and is due by February 4th, or a similar date depending on issuer timing. A purchase that posts January 12th lands on the February statement and will be due in early March. If you pay the January statement in full by January 31st, you avoid interest on those January charges and preserve your grace period for new purchases. Now here are the steps to stay interest-free. First, enable automatic payments for the full statement balance each month. Second, add both your closing date and your due date to your calendar with reminders. Third, do not panic about charges that occur between your due date and your next closing date. Those will appear on the next statement and are not immediately due if you already paid the prior statement in full. Fourth, monitor postings because only posted transactions are counted on the statement. Finally, if you ever lose the grace period by not paying in full, pay the balance down to zero to reset. Then resume paying the full statement balance by each due date to regain your grace period. Next, let's bust some myths. First, you do not need to pay the entire current balance to avoid interest. You need to pay the statement balance by the due date. Second, purchases made after the due date do not automatically incur interest. They are included on the next statement and are covered by the grace period as long as you paid the prior statement in full. Third, making multiple extra payments within the same cycle is not required to avoid interest, though it can help with utilization or budgeting. Quiz time. The question is, to avoid interest, what must you pay by the payment due date each month? Option A is your current balance. Option B is your statement balance. Option C is only the minimum payment. Option D is your previous and new charges together. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, your statement balance. Paying the full statement balance by the due date preserves your grace period and keeps interest charges at zero. Here is the second quiz. A purchase that posts after the closing date will appear when? Option A says on the current statement and due now. Option B says on the next statement and due next month. Option C says as an immediate cash advance. Option D says as interest only until paid. You may pause the video now to consider your choice. We will discuss the answer in the next section of the video. The correct answer is B. A purchase that posts after the closing date will appear on the next statement and be due the following month, assuming you continue paying statements in full. Now let's look at the billing cycle timeline. The diagram should show the start of a billing cycle, purchases posting during the cycle, and the statement closing date acting as the meter reading. After closing, the grace period spans roughly 21 to 25 days, ending at the payment due date. Paying the full statement balance by the due date preserves the grace period into the next cycle. Also shown is that purchases posting after the closing date move into the next cycle automatically. Next, here is a quick cheat sheet. Remember to pay the statement balance by the due date. Track the closing date to know what is included on the statement, and the due date to know when payment must be made. Set autopay to the full statement balance. If you make purchases after the due date but before the next closing date, those charges roll into the next statement. No immediate action is required if you paid the prior statement in full. Moving forward, consider these nuances. Some issuers report balances to bureaus on the closing date, so paying before closing can reduce reported utilization. Only posted transactions count. Pending items do not affect the statement. If you miss paying a statement in full, interest can accrue. Pay the balance down to zero, and then resume paying the statement balance by each due date to restore the grace period. With multiple cards, staggered closing dates can help smooth cash flow. Finally, returns processed after a closing date generally reduce the next cycle's balance rather than the prior statement. To recap the most important points, always pay the full statement balance by the due date to keep interest at zero. Charges after the closing date fall into the next cycle, so there is no need to panic if you have paid the prior statement in full. Set autopay to the full statement balance to remove human error. Finally, track your closing date and due date to control your grace period. Before we finish, a quick disclaimer. This video is educational and not financial advice. Card issuer policies and timelines can vary by product and country. Always review your card's terms, statement details, and customer service guidance for specifics that apply to you. In summary, the closing date is the meter reading that defines what appears on your statement, while the due date is the payment deadline. The golden rule is to pay the statement balance in full by the due date. Use autopay to lock in your grace period. With this approach, you can leverage 4 to 8 weeks of interest-free financing, depending on timing. Thanks for watching. If this helped you, please like the video, share it with someone who needs it, and subscribe for more practical money tips. Tell us in the comments how you plan to use your closing and due dates to stay interest-free.